Disclaimer: this video is for educational purposes only, not financial advice. Trading and algorithmic trading involve risk. Past performance, including backtests and strategy results, does not guarantee future results. Always do your own research. A lot of traders were bullish on gold, and they were not wrong. Gold was moving higher, the trend was strong, and the bigger picture looked clear. But here is the problem. Being right about direction does not automatically mean you make money. Many traders still lost money because they entered too late, chased breakouts, ignored pullbacks, used poor stop placement, or got shaken out during choppy price action. That is the gap most traders do not understand. Market direction is one thing, execution is another. In this video, we are going to look at why being right about gold still does not guarantee profit and how a more structured trading framework can help traders avoid emotional entries, fake breakouts, and poor timing. Let's start with the basic idea. When gold is trending higher, it is easy to look at the chart and say, the market is bullish. But trading is not only about knowing the direction. A bullish market can still move down before it moves up. It can break out, pull back, retest, consolidate, or create false signals before continuing the trend. This is why many traders lose money in a market they read correctly. They are right about the overall direction, but wrong about the timing. For example, imagine gold is in an uptrend. Price makes a strong move higher. A trader sees the breakout and enters immediately because they are afraid of missing the move. But shortly after entry, price pulls back. The trader starts to panic. Maybe they move the stop loss. Maybe they close the trade early. Maybe they add another position too soon. Then price eventually continues higher without them. The direction was right, but the trade management was wrong. This happens because trends do not move in a straight line. Most trends move in waves. Impulse, pullback, continuation. Another impulse, another pullback. If a trader enters during the impulse, they may be buying after the move has already expanded. That means the stop loss may be too wide, the risk to reward may be poor, and the trader may have very little room to survive a normal pullback. This is one reason chasing price is dangerous. The market can be bullish and still punish late entries. Another common problem is fake breakouts. Gold can move above a key level, attract breakout traders, then quickly reverse back into the range. To a beginner, that may look like the market changed direction. But in many cases, it is just liquidity being taken before the next move develops. This is why entering only because price breaks a level can be risky. A breakout needs context. Where is price in the trend? Is there confirmation? Is volume supporting the move? Is the stop loss in a logical place? Is the risk to reward still acceptable? Without structure, a trader may simply be reacting to price movement. And reaction is not the same as strategy. The next issue is stop placement. Many traders place stops too close because they want a bigger position size. But gold can be volatile. A normal pullback can trigger a tight stop before the original idea has time to work. Other traders place stops too far away because they do not want to be wrong. That creates a different problem. The risk becomes too large compared to the potential reward. So even if the trader wins some trades, one bad trade can damage the account. This is why stop placement should not be emotional. It should be based on structure. Where is the trade idea invalidated? Where would the market have to move to prove the setup is no longer valid? That question is more useful than simply asking, how much do I want to risk? Another reason traders lose in bullish markets is position sizing. When traders feel confident about direction, they often increase risk. They think, gold is clearly bullish, so this trade should work. But confidence is not risk management. A strong market can still produce losing trades. If the position size is too large, even a normal losing trade can create emotional pressure. And once emotion takes over, the trader may stop following the plan. This is especially important for prop firm traders. In a prop firm account, being right eventually is not enough. If the trade creates too much drawdown before it works, the account can still fail. That is why prop firm trading requires more than direction. It requires timing, risk control, and rule awareness. Daily drawdown,
maximum loss, and position sizing can turn a good market view into a failed account if the execution is poor. So what is the solution? The solution is not to predict gold perfectly. The solution is to build a structured trading process.
A structured process helps answer a few important questions before entering a trade. What is the market direction? Where is the setup? Where is the invalidation point? What is the risk? What is the reward? What conditions must be true before entering? And what conditions would tell me not to trade? For example, instead of buying gold just because it is moving up, a trader may wait for a pullback into a key area. That area could be a previous support level, a moving average, VWAP, a demand zone, or another part of the trader's tested framework. The point is not that one tool is magic. The point is that the trader is no longer chasing. They are waiting for price to come to a planned area. That creates better structure. It can improve stop placement. It can improve risk to reward. And it can reduce emotional decision-making. This is where systematic thinking becomes useful. A systematic trader does not simply ask, "Do I think gold will go up?" They ask, "Under what conditions do I take the trade?" They also ask, "Has this setup been tested? Does it survive different market conditions? What is the typical drawdown? What happens during choppy periods? How does it behave after fake breakouts?" These questions matter because trading is not about one prediction. It is about repeated decisions over time. One good call does not make a trading system, and one bullish view does not guarantee profit. The goal is to create a process that can be repeated, measured, and improved. This is also why backtesting and trade review are important. After a trade, the question should not only be, "Did I win or lose?" The better questions are, "Did I follow the setup? Was the entry planned? Was the stop logical? Was the position size correct? Did I chase? Did I exit emotionally? Did the market behave in a way the strategy was designed to handle?" These questions help traders improve the process instead of only focusing on the result. Because sometimes a good trade loses, and sometimes a bad trade wins. If a trader only judges by profit and loss, they may learn the wrong lesson. So the key message is simple. You can be right about gold and still lose money. You can identify the trend correctly and still enter at the wrong time. You can catch the direction and still fail because of poor risk management. And you can have a profitable idea that does not fit a prop firm rule set. That is why trading needs structure. Direction matters. But execution, risk, timing, and discipline matter just as much. So before entering the next gold trade, ask yourself, am I following a tested process? Or am I just reacting to price? That one question can change the way you trade. Being right about direction is not enough. A trader also needs structure, timing, risk control, and a process that can be repeated. In the next video on this page, we'll continue with the next step in the framework,